Welcome everyone to this webinar on blockchain technology. It's a beautiful but a bit chilly day in New York City, and we're happy to have you with us. So today we're going to look at some of the biggest trends in this sector. To do that, first we're going to talk a bit about nomenclature and naming conventions. Lots of different stakeholders are talking about this technology using different definitions and names, so we're going to touch on that and explore that a bit. Once we finish defining the sector, we'll dive into key trends in private blockchains and distributed ledgers with the work that are being done primarily by corporate players. Then we'll look at trends in public blockchains, which is where all the ICOs and tokens you've heard about live. Finally, at the end of this webinar, we'll recap and take questions from you, so stay tuned. So first, let's talk about nomenclature and how blockchain can mean different things to different stakeholders. So now we're just going to quickly show you a bit of our platform and how we use it to look at trends and naming conventions. So as you can see here, we're using our platform to search for terms related to blockchain. So the first one is distributed ledger, and we could search for news coverage of that term. We could also search for coverage of crypto and related news mentions and coverage around that. Then, of course, blockchain, and lastly, Bitcoin. And you can just see from this chart how each of these have trended over time, but also which ones or which terms people use to describe or talk about what's happening in this sector most often. So obviously, Bitcoin leading the pack there, followed by blockchain, then crypto, and then all the way at the bottom for corporates, distributed ledger. So to put it another way, let's think about where blockchains as a technology live. So really, blockchain databases are meant to be more decentralized or decentralized database systems, and we'll get into what that means. But in contrast, distributed ledgers, where a lot of the projects are being explored by corporates, are more centralized and often have administrators that sit on top of the databases. So really, you can see here that blockchain is just a type of database, and even more specifically, a type of distributed ledger. So again, looking at distributed ledger projects specifically, these are some of the more prominent blockchain for enterprise projects. The thing is that blockchain is all about decentralization and enabling market activity peer-to-peer without middlemen. In many cases, corporates don't need this decentralization. It just doesn't really make sense. So many of the projects have pivoted toward more general distributed ledger technology projects as a technology. This is not to say that blockchain is unimportant. On the contrary, if blockchain gets corporates to collaborate more and have better governance practices around data, that's great. However, distributed ledgers should be differentiated from pure play blockchain systems. So what are pure play blockchains? Well, these are public and more decentralized. So when you think of big public blockchains, think of Bitcoin or Ethereum, and these are attempting to reimagine what could be done with money and with a new decentralized web, peer-to-peer without middlemen. And let's frame this another way. So all the way on the left here, we have blockchain technology as the starting point of this conversation. And then you have public blockchains on the top, which leads to things like cryptocurrencies, and then crypto assets, tokens, and ICOs. Then on the bottom, you have private blockchains, otherwise known as distributed ledger technology. So you can see that when corporates and startups talk about blockchain technology, they're not always talking about the same thing. Now that we've discussed nomenclature, let's look at some of the trends on the corporate side of things in distributed ledger technology, or DLT. So here again is our framing of the sector. On the bottom, we have DLT. Again, this isn't to say that at the top, public blockchains aren't important for corporations or corporate innovation teams. It's just to say that blockchain technology broadly is a conversation around how we govern and manage data. And since some companies are still using siloed databases from the 70s, it's a big deal in and of itself if blockchain technology as a conversation gets corporate players to rethink how they share and store data. And just to illustrate this long-standing divergence, here's a quote from Goldman CFO Martin Chavez highlighting this point. We really want to distinguish the blockchain, which is an area of huge emphasis and investments across our industry and across many industries, from a particular application of blockchain which tends to get all the news cycles, which is cryptocurrencies. And indeed, some of the most active investors in distributed ledger technology have been banks. This isn't a coincidence. Bitcoin, the first blockchain, is a financial product after all. Banks were the first to try to, quote, domesticate it and see what they could do with its underlying technology. To this end, many of the top banks have placed bets on DLT. Investments into Axoni and Digital Asset by all three of these banks were bets on distributed ledgers for the back office. Banks have also joined consortia like R3, which, consortia are attempts to explore the technology in a group setting alongside peers. Other corporate players from other industries, aside from financial services, have not been far behind. So lots of companies have played with it. The problem, though, is that many pilots have stalled. On the left here, you can see some companies have decided to stop their projects. And on the other side here, these projects have yet to see meaningful usage and results, even after years of experimenting. One key trend that we're seeing is the role of tech consultancies like IBM in this space. IBM, in particular, continues to double down on DLT in terms of headcount and resources devoted to the technology. Here are 3 projects that IBM is involved in that IBM has really spearheaded with partners that range from food supply chain on the left to cross-border transactions to payment netting. So, the idea of tech consultancies enabling DLT is certainly an interesting trend that we'll continue to watch. More directly, some supply chain pilots are seeing positive results with DLT, and you can see here some of those projects and partnerships that have formed around DLT for supply chain. Overall, though, the hype among corporates around blockchain technology is slowing dramatically. Just by looking at earnings transcripts, you can see that mentions in this year's 4th calendar quarter are way down. In a recent JP Morgan call, the company said that its blockchain efforts were really at the inquiry and information sharing stage, and not yet production ready. This is coming from a bank that's done a lot with the technology in terms of investments and pilots and projects to limited success. And here's a quote from Angus Champion, a former DLT consultant at EY, that highlights some of the issues around DLT for corporates. To implement a corporate blockchain, you need to form some sort of consortium, define standards, and set governance. Generally, when you're doing that, you end up forming some central body. Once you've formed a central body, you've done all the complex coordination required. When you want to build a blockchain, the tough bit is getting all the different parties together. And once you've done that, blockchain is a pretty inefficient technology to use to implement the solution. And just to more directly answer the question about why a public blockchain, as opposed to an administered DLT, might not be a good fit for business, well, first of all, getting untrusted parties to come to agreement, as Angus just mentioned in the previous slide, that's not easy. And coming to consensus on the state of the database, or even just on the rules of the database, is really difficult. Second, users are sovereign. This means that everyone's equal in a pure blockchain. No single voice is more or less powerful about the database. So let's say in an enterprise blockchain, one company goes rogue and starts trying to falsify data. There's no way to kick out the offending party in this situation. Remember, we're not using a middleman in a pure play blockchain to administer the database. And given both these points, the question becomes, do corporates really need a decentralized database that nobody administers? If the answer is no, then centralization is often a much faster and easier solution to implement. So that was a look at what's going on in private blockchains and DLT. What's happening in more decentralized public blockchains? So first, let's define what we mean when we say a decentralized blockchain. So a blockchain is a database where untrusted parties come to agreement on the state of the database without using a middleman. And I'm sure we've all heard, thousands, at least I have, thousands of different definitions over the past year and change about what a blockchain is. So just to back to this for a moment, in Bitcoin, as an example, the ledger is public. So peers can transact with each other without a middleman and can trust through effectively mathematical equations that secure the blockchain that other peers have received or paid the correct amount. Of course, there's a lot more stuff out there now than just Bitcoin. So how should we think about crypto assets generally, or crypto assets based on public blockchains? Let's now talk about 2 types of them. One is utility tokens, which are tokens that want to reshape the web. Think a decentralized Facebook or Uber. And the second type of crypto asset, which we'll touch on, are security tokens, which want to place traditional assets, like stocks and bonds, onto a blockchain. And we'll get into each of these. First, utility tokens. The major trend here, and this has a lot to do with ICOs, is that plans of utility tokens reshaping the web haven't really happened yet. Speculation has largely dried up, regulators have clamped down, and users are failing to show up. So let's frame utility tokens within the broader blockchain conversation. What we're talking about here is public blockchains, and then we're talking about crypto assets, not cryptocurrencies like Bitcoin. And then within crypto assets, we're talking about utility tokens, which are tokens that offer utility within decentralized networks. So what's the problem that utility tokens are trying to solve? Well, the internet today is largely centralized. We're all familiar with controversies swirling around internet privacy, security, Facebook, Google. In other words, the centralized web today, dominated by a select few companies, has lots of problems. Here's a quote from Steven Johnson, who wrote a great piece in the New York Times a couple of months ago that should help us frame the conversation around blockchain as a potential cure. The real promise of these new technologies, many of their evangelists believe, lies not in displacing our currencies, but in replacing much of what we now think of as the internet. So what does this mean? What does it mean when we say replace the internet? Well, maybe blockchain and tokens or crypto assets could reorganize the web. Like Bitcoin, can we build applications that are decentralized with nobody in charge? The idea behind utility tokens is that we can, through a complex incentive and game theoretic system, we can combine different technologies and economic systems to incentivize people and create utility within decentralized applications. And as you can see in this market map, there's a token for every area of the internet. There's tokens for e-commerce marketplaces, identity management solutions, and asset management. The idea is that a team builds it and then melts away, leaving a self-operating, decentralized network. The problem is that many of these companies trying to rebuild the internet have been distracted by a new fundraising mechanism, initial coin offerings, or ICOs. An ICO, as many of you have seen over the past year, is when a team sells tokens to the public in exchange for, effectively, seed funding. However, ICOs are pretty sketchy from a regulatory standpoint, and many teams have failed to ship any kind of product. And just to give a sense of the regulatory hot water many of these companies now find themselves in, here's a recent quote from Jay Clayton, chairman of the SEC. If you finance a venture with a token offering, you should start with the assumption that it is a security. Many of the companies that launched did not think they were issuing securities and therefore offered illegal, unregistered securities. This has led to a broad crackdown on the funding mechanism, on ICOs, with the SEC starting to charge certain companies with unregistered securities offerings and subpoena lots of others. And then, of course, there is the problem that these utility tokens don't yet offer much utility. Many companies have yet to ship any sort of product, and even the ones that have shipped products are barely seeing any usage. In recent days, we saw well fewer than 10,000 users across 19 of the most popular decentralized applications, or dApps. So this regulatory crackdown combined with low usage numbers has kept mainstream institutional investors away from this sector. A common refrain in late 2017 and early 2018 was around the entrance of institutional money, which would inject capital into the sector and effectively rubber stamp utility tokens as a valid emerging asset class. With institutional focused projects like the Coinbase Index Fund shutting down, this logic is under fire. And of course, this has led to a reversal in ICOs, with ICO funding numbers way down and traditional venture funding to blockchain-focused companies back on the upswing. So just to recap what we're seeing in utility tokens then, speculation has largely dried up, regulators are clamping down, and users have failed to show up. On the other side, we have security tokens, which are seeing lots of investment. However, these projects might face similar challenges to those faced by corporates in earlier attempts to tokenize financial assets. Again, let's frame where security tokens live. These are basically assets, stocks, bonds, and then more liquid assets like real estate or fine art that are assigned tokens which are then placed on public blockchains. The idea here is that blockchain technology will allow for a new decentralized financial stack. And just like utility tokens are trying to build a decentralized applications for a decentralized web, security tokens are trying to build decentralized ownership records for a decentralized financial system. And according to news coverage, security tokens look like they're the new narrative in this sector, recently surpassing utility tokens in terms of news coverage. So what are we talking about when we say decentralized finance? Here's a quote from Will Warren, the CEO of ZeroX, which is a protocol to build decentralized exchanges. We envision a world in which all forms of value are tokenized on public blockchains. Combined with a set of open financial primitives, we can build a global financial system that is more efficient, transparent, and equitable than any system that has existed in the past. So let's imagine a world where stocks, bonds, real estate, even derivatives are all tokenized and placed on public blockchains. What does this mean? It could mean fewer databases, ones that are trusted and interoperable. It could mean decentralizing trust around important and valuable assets. And combined with other parts of a decentralized stack, security tokens could totally rethink the financial system. And just to give a sense of how dramatic this narrative shift towards security tokens looks, here's a chart showing how, as Bitcoin has declined in price, along with other crypto assets and cryptocurrencies, some of the biggest exchanges who make their money off of speculation and investment, like Coinbase, Binance, and Circle, are starting to invest directly in projects as well as acquire companies. And many of these investments and acquisitions have been focused on security tokens. Securitize is one example of a security token company and just received funding from Coinbase and Ripple, among other investors. The company hopes to develop the frameworks necessary to tokenize companies and their shares, and then trading of those security tokens could take place on exchanges like Coinbase, which actually received approval in July to list security tokens on its exchange after the company's purchase of registered broker-dealer Keystone Capital. Another example of exchanges playing in security tokens is Circle's acquisition of broker-dealer Seedinvest, which positions Circle to help businesses raise capital in security token offerings and then exchange those securities through its trading arms. And while not an exchange, Overstock, the popular e-commerce retailer, looks to be making a pure pivot to blockchain technology and security tokens. Overstock's CEO, Patrick Byrne, has said that he's in talks to sell the company, and he has made repeated bets on blockchain technology through Medici Ventures, which is a subsidiary of Overstock. Among those bets is tZERO, which hopes to be a platform to track and trade security tokens that represent traditional assets like stocks and bonds. And while tZERO has yet to launch commercially, it raised $134 million in its own security token offering. Another one of these security token companies that's made headlines is Harbor, which has raised $38 million from a couple of smart money investors. In November, the company announced its first tokenized investment, just this month, the $100 million hub at Columbia REIT, which is part of the University of South Carolina. Given all this, though, it's wise to remember that some of the first experiments financial services organizations did with blockchain was around tokenizing financial assets. This new set of security token companies could face some of the same challenges that corporate players have faced. For one, regulatory buy-in is still needed. Just because a blockchain says you own a house, does it mean that you own the house? What would a court of law rule? Then, of course, databases are often full of errors. Is a blockchain which is really difficult to change the right solution in an error-prone world? And lastly, for all the talk of interoperability and systems with little downtime, existing financial systems work quite well and enable dynamic global marketplaces all over the world. Do we need a pure-play, decentralized blockchain to take over that role, at least in the near term? So now we've looked at the crypto asset side of things, specifically security tokens and utility tokens. Now let's turn to the cryptocurrency side of things and get back to basics with Bitcoin. So how should we think about cryptocurrencies? Here's a quote from Dong He of the IMF that underscores the importance of Bitcoin's creation. Cryptocurrencies may one day serve as alternative means of payment and possibly units of account, which would reduce the demand for fiat currencies or central bank money. Of course, we're nowhere close to this happening yet. Bitcoin isn't really a store of value if its price can go from about $20,000 at its peak a year ago to its price today hovering around $4,000. And people still don't use Bitcoin as a medium of exchange to purchase coffee or for purchases online. And you can see that here just in terms of media mentions. More generally, interest in Bitcoin altogether has fallen alongside its price. So where does that leave us? Was Bitcoin just the latest tulip bubble? Another way to think about this is Bitcoin's security. And really, Bitcoin isn't dead just yet. Here's a chart showing Bitcoin obituaries by year, or articles saying that Bitcoin is dead. This hasn't happened yet, and from a technological standpoint, Bitcoin remains a marvel. Nobody has hacked it, and it's very much still alive, even if the price of a Bitcoin is down. Indeed, according to proponents, Bitcoin is still at its earliest stages, and we're really just getting started. If Bitcoin gains more acceptance as a store of value through greater perceived safety, greater education, greater liquidity, greater custodial services, etc., then it could ultimately become a more widespread medium of exchange. And if that happens, it could even turn into some sort of real viable alternative currency or unit of account. In other words, it's still very early days. And more promising are attempts to scale Bitcoin and allow for Bitcoin to become a medium of exchange in the short term. Here's a visualization of the Lightning Network, which is a second layer on top of Bitcoin, as well as the Lightning Node, which are both important development efforts to make Bitcoin faster. If Bitcoin's faster, then that means you could one day buy a cup of coffee with it. The Lightning Network is attracting developers and helping Bitcoin become digital money. This then could challenge central banks and monetary policy. Another issue, though, is Bitcoin's volatility. It's really just too volatile to use as a currency. Compared to the US dollar, there's no question of which currency consumers and businesses would prefer to spend or park their money in, and it's not Bitcoin. Enter stablecoins, which are exactly what they sound like, stable cryptocurrencies as alternatives to Bitcoin. And you can see here that this is another pretty strong trend, narrative trend, happening in the sector, with news coverage really skyrocketing in 2018. And lots of companies and teams are employing different strategies to create stable cryptocurrencies that more closely mirror the US dollar or euro than, let's say, Bitcoin or Ethereum. To highlight one, Basis is a stablecoin, a cryptocurrency that hopes to be less volatile. To do this, Basis is building a cryptocurrency pegged to the US dollar, and the network automatically sells bonds to increase or decrease supply and maintain the peg. If it works, what we're talking about is a decentralized cryptocurrency that's stable, which could enable other pieces of this decentralized financial stack. Of course, there are, and here's the Basis slide, Of course, there are still issues here, and stablecoins have to prove that they're really stable. But if they work, then that's another piece added to a blockchain-based decentralized financial and monetary system. Now let's cover a lot. We've covered a lot, so let's recap quickly. So just think back to our framing again. We've really covered 4 specific areas today: distributed ledgers and corporate applications, utility tokens and security tokens as part of crypto assets, and then cryptocurrencies. The major trend in each is for distributed ledgers. While they're not exactly blockchains per se, they could reinvigorate conversations around corporate data sharing and governance. Then for utility tokens, their plans to reshape the web haven't panned out yet, but development continues apace as crypto's bear market flushes out bad actors. For security tokens, projects are seeing lots of investment, but could face familiar challenges faced by earlier asset tokenization projects. And lastly, for cryptocurrencies, they might still be blockchain's best use case, as stablecoins and second-layer protocols hope to enable adoption. And that's all we have today. Thanks so much for tuning in. Now we're going to open the floor up for questions, which you could ask here, or on Twitter, or via email. Okay, so just one question coming from you. What industry is the most likely to make use of distributed ledgers in the short term? So I think when we think about industries that could make use of this, and we touched on a couple earlier in terms of financial services and industries that have some sort of complex global supply chain, we really have to think about distributed ledgers and blockchain as a horizontal technology. So anywhere that could use better data sharing, better governance, could potentially use DLT or blockchain. It's not a cure-all, but it is an IT infrastructure for corporates, and there's a lot more there than just saying put everything on the blockchain. It's much more complicated than that. But in terms of industries in the short term that we've seen that are promising, certainly supply chain is an early and promising use case. We've seen some experimentation in IoT. We've seen some experimentation in financial services, obviously, quite a bit of experimentation there. But to be frank, we're still waiting for the Netscape moment in terms of corporate adoption. We haven't seen that just yet. But yeah, I would point to a couple of those sectors, and happy to share more via email or Twitter. In which areas is blockchain most overhyped? So again, back to our our taxonomy and splitting blockchains into public and private. On the public side, certainly ICOs, initial coin offerings as a funding mechanism. Ultimately, a lot of people lost a lot of money with initial coin offerings. It ended up being a situation where companies would raise funds without any sort of legal or regulatory guidelines to a large degree, and then promise to build a network that often didn't materialize. So certainly when we talk about areas that are overhyped, although we've seen that hype die down, ICOs is certainly an area to point to. And then on the corporate side, financial services, FSOs and big financial services organizations have been experimenting with blockchain for, I would say almost 6 years at this point. And there's been so much talk about applying that technology, and really it hasn't made that much of an impact yet. So we're still waiting within corporate back offices and back offices of big banks for blockchain and DLT to have some sort of more widespread impact. What are these scaling bottlenecks, and how are projects trying to resolve it? Yeah, so in the blockchain space, there's a term that's been coined called the scalability trilemma, and just by the nature of decentralized systems, you automatically have issues with scalability. So if you think about it, one computer talking to one computer is quite easy, but thousands of computers or millions of computers all talking to each other and verifying that each computer holds a copy of the same information, just naturally it takes a long time. So there's 3 issues with scalability. One is how do you scale a decentralized system? 2 is how do you make sure that it stays decentralized? And 3 is how do you make sure that it stays secure? So there's lots of ways that companies are trying to scale, either by making the systems less decentralized or making the blocks smaller or faster or holding different sets of information that don't take as long to propagate to the network. But of course, we always get back to this 3-pointed trilemma here. How can we make sure to have strong security, scalability, and decentralization? What metrics should companies be evaluated on right now to determine their success in terms of the number of transactions, the speed of transactions, etc.? That's a good question. So I think there's a couple of metrics that could be used to judge early success, because we're still waiting for a lot of companies to really launch their products, although some have. But there's a couple of key metrics. One is users, and just seeing sustained user count and usage activity and active users is obviously an important metric. 2 is the development community and the amount of developers, especially for smart contract platforms like Ethereum, Dfinity, Tezos, others. Seeing that other teams are developing on top of these base layer protocols is certainly an important thing. 3 is code base activity, making sure that the GitHub or code base repositories for these teams are active and constantly being updated and debugged, etc. 4 could be academic peer review. A lot of these ideas are very theoretical and quite out there in terms of cryptography and economics. So certainly peer review could be useful. And to a certain degree, the 5th one could be money raised from traditional VCs. Companies should definitely not be judged by the size of their market cap or the amount raised in an ICO. just because from a regulatory standpoint and also from a speculation perspective, regulatory guidelines have yet to be fully embraced, and a lot of companies are still might still find themselves in hot water. And in terms of speculation, that really has died down. So it's hard to point to market cap as a good metric of a company's success. With that, we have to end. We will thank you all for tuning in. It was really a pleasure taking your questions and giving you all this information. The recording and slides will be sent via email shortly after this, and we look forward to seeing you next time and hearing from you. Thank you all for tuning in. Have a good day.